What's going on, guys? Brian here. Today is Thursday, May 16th, 2024, and the market is open as I'm recording this video. Broken wing butterflies have become my favorite out of the money momentum speculative options trading strategies over the past year or so. I love them because the risk to reward is amazing. They're great for speculation because you're not going to be punished if you are wrong. In this case, this is a long call broken wing butterfly. The trade was opened at the start of this week. We'll get into the charts in a little bit, but this is a general video, so it's not specifically about this particular trade. I just want to highlight or showcase this strategy that I don't think gets a lot of attention. Therefore, I don't think a lot of people know about it. We will weigh its pros and cons, and we will also compare it to just buying a call option. You can trade this also with puts. If you're speculating that a stock, or in this case here, the SPX is going to go down. This trade, since it was opened up on Monday morning, Eastern time, it is currently up about 850% based on the debit it was paid for. So if you don't like credit spreads, the first thing to take note of is this is a debit, which for a beginning trader might be a little bit easier to conceptualize. A butterfly spread, in case you do not know, is comprised of 3 different strikes. You sell 2 options of the same strike, and then you buy options that are on each side of that strike. These are referred to as the wings, and this is referred to as the body. And this order is submitted at the same time, therefore it is called a spread. Your broker or your platform makes it very simple to actually submit this order, whereas explaining it can make it seem as if it's more complicated than what it actually is. Now, what makes this a broken wing butterfly is the fact that the distance between the wings are not the same. So if I was to open up another butterfly, for example, right here, and we typed in the SPX, and by default, you see this is going to have even wings. So this is just going to be called a long call butterfly. It is not broken wing. If we were to move one of the wings, that will make it broken. So this is a butterfly, but if I were to pull this one out, we're now making this wing broken. And that's what's going to create a broken wing butterfly. So let's close this out and jump back to this trade again, which is just an example to show you guys the potential. This is Option Strat, by the way. It is by far my favorite platform for trading options. If you're doing any type of risk assessment on your spreads, I highly recommend Option Strat. I've been using them for years, and I can accredit most of my success as well as understanding of options has come from using this platform. Because of the user interface and because of how aesthetically pleasing it is to me, it makes it very easy to be able to understand this. If you're just looking at an options chain and you're trying to assess your risk, it becomes very difficult versus being able to just click and drag the strikes and being able to see the representation on the chart, as well as exactly how much margin the trade is going to cost you, if it's going to be a credit or a debit, and also what your max profit is. It makes it very simple. You can also see the Greeks right here, which we'll get into a little bit later. Let's jump over to the chart and take a look at what's been going on this week here. Wednesday was the CPI report. It came out pre-market, so the market had gapped up. This trade, however, was opened at the start of the week. You can trade out of the money butterflies and you can trade out of the money broken wing butterflies if you're going to speculate on a direction. However, if you're going to speculate on a major direction, you generally want to trade it whenever you know there's some sort of major catalyst for the SPX. I focus mostly on the SPX for these types of trades as they are cash settled. You don't have to worry about any type of assignment risk, and there are a couple other perks involved. The liquidity is there, and you don't really have to stress out that much about getting filled for an open and close on these types of trades, especially if you're trading them within the weekly expiration. So on Monday, on the left-hand side here, I have the SPX, but I use the SPY for most of my analysis. I just have some levels on my charts. These are coming straight from the gamma exposure. That is one of my biggest edges at the start of the week. I like to do an analysis of the gamma exposure for the week. That is a subject for a separate video, so I won't get into that in this video, but I do have links in the description to my gamma exposure playlist, and you can learn more about that below. At the start of the week, the SPY was holding above a key level, which is 520. Now, if you don't know, there's a little bit of a difference between the SPY and the SPX. They both represent the S&P 500, or I like to consider that they're both a derivative of the same thing. That can make it a little bit confusing regarding your strike prices, but in my opinion, for consistency, when you're doing a weekly assessment of your levels, I would recommend using the SPY. And then you can always convert the levels to the SPX if you need to. There is a site right here that was shared. I was not aware of this site, but members within the Quant Trading App Discord had mentioned it, and I think it's also an excellent tool. So in this case here, if you have this level of 520 and you want to know what level is that on the SPX, you can just type in 520 right here, for example, and then you just press convert. So the side is SPY converted, you press convert, and then there you go, you get the level. And then you can just plot that level right on the chart here. So I just drew this correlation just so you guys can see it. So this purple strike is the same one here. This is the SPY P1, so this is 521. It's just a conversion right over here. So at the start of the week, as the SPY was holding within this region here, which at that time I was speculating to act as support leading into the CPI report, my expectation would be that the SPY would actually have an explosive move to the upside. This was the previous all-time high, so this is the extended hours. The all-time high was put in an overnight session. So I left this note for myself, letting me know that it didn't occur during the regular trading hours. Therefore, having the understanding that if the SPY did gap up and we were holding above this level during the regular trading session, because I have the extended hours turned off here, but if during the regular trading session, if the SPY was holding above this, it means the SPY, aka the broader market, is holding above a key level, which is the all-time high level during the regular trading session. Technicals aside, because this video is not a focus on understanding price action or any of that, I'm just trying to paint the picture behind why I would speculate that the SPX would make some sort of a rally. On top of that, I know if I just shared the broken wing butterfly, some of you might be asking or questioning why the strike selection. 530 is a significant level for the SPY, so that equates to about 53.11 on the SPX. So this was the level that I imagined if the market was to pick up on some momentum, that's where it would want to go. So at the start of the week here on the SPX, I wanted something that targeted this region. Normally I would go with the Friday expiration, but I went with today's expiration just because I had another position already open for the Friday. So I didn't want to overlap different spreads on the same day. Thursday or Friday, both of these days, the trade would have worked out well. Now, if we jump back to the actual trade here, I want you guys to pay attention to the risk profile, and we can see how it has this nice curve. Now, this type of curve right here is the asymmetrical curve that I love. So if you're opening the trade down here, it means if you are wrong, you're not really losing much relative to how much you can gain if the price was to go in your direction. So let's say, for example, we wanted to speculate on next week, and we think that the SPX is going to continue rallying. And let's just say we're going to choose the Wednesday expiration for next week, and we think the SPX is going to conservatively maybe rally up to about, we'll call it 53.75. This is our regular butterfly. So this is a nice balanced butterfly. It's not broken wing yet. As you guys can see, there's the same risk on each side of the trade. But now let's just say we want to reduce our risk on this side because we want to pay less. We think this debit is a little too high, it's too expensive, and we want to reduce the price. You guys see what I did? I just pushed in the left wing closer to the strike that I'm actually shorting, so closer to the body, and then that just cut the cost down. If we push it again, we're going to cut the cost down even more. So now this is going to cost us 35 cents to actually open this trade, which you guys can see is really cheap. But there is a trade-off whenever you go too cheap with the trade, and that's going to affect the Greeks. So right here, if you guys notice, the Greek is now negative. If I were to pull this here, we can see that our delta is positive. So how does that affect us if you don't understand the Greeks? The Greeks are great to understand, but even if you don't understand the Greeks, this is why I love option strat. You can see it right here on this picture and this graph. And the longer and longer that I've been trading, the less and less I've actually been paying attention to the Greeks. And I like to just look at things on this graph. I'm a cinematographer outside of trading. I'm also a photographer. So anything that can allow me to look at something aesthetically pleasing or anything that's pleasant on the eyes, I prefer to look at. I have a slight number dyslexia. So the less and less I have to pay attention to small numbers and fractions actually helps my brain. It puts it at ease. So just looking at this picture here, look at the difference. This is the current spot price of the SPX. If the SPX was to continue to go up, you guys can see that this is within profit right here. This is our profit zone. If we were to make this broken wing too broken and we push this in, we can see that yes, it is cheaper, but then look what happens to our profit zone. It now is closer to the money, meaning if the SPX was to keep going up, we can actually put this right here. This is the current, this is right now. If the SPX was to keep going up, we'll actually be losing money on the current T+0 line. So this is the profit and loss currently. As we slide this here, this is the profit and loss into the future. So we know by next week, in this case here, by next week, Tuesday, this is Eastern time, this trade will be profitable. However, the journey to get there will be a little bit of pain if you are holding this. As you guys can see right here, the trade will actually be losing money. That is coming straight from the fact that it has a negative delta. So if we are speculating that the price is actually going to go up, we might want to have our delta be positive. So by keeping it within this range here, you guys can see our delta is positive. So that means as the price goes up, you guys can see this trade will actually be profitable. Now it won't be profitable by much, because it's still a broken wing butterfly versus a balanced butterfly. You guys can see right here, as the price went up, we don't really have to worry at all until price got really, really far. But at that case here, you can take profit well before it reaches the other side of your butterfly. The trade-off with this butterfly is, as you guys can see, if we are wrong, look what happens this way. You can lose a lot, and it's almost a 1-to-1 ratio here. To improve those odds for if you are wrong, that's why I like to make it broken wing. As we pay attention here, let's just say we are wrong, you're not really losing that much. So if the SPX was to drop back to 5,300, which would be right here, this trade will be down about $50. If it was a balance and the SPX dropped back down to 5,300, this trade will be down about $130. So almost 3 times as much in terms of risk to the downside, or that's at least the way I like to assess that. Now, if we go back to this butterfly, there is risk all the way to the upside if price was to go way too far. So that's why you'll see your max loss is much higher than what you're actually paying for the trade. The thing is, price has to pass the strike in which you're speculating on. So as price is moving up, time is also going to be passing by. So in this case here, you have an opportunity to take profit. If you see that price action is moving way too fast and you are uncomfortable with the trade, you can always take your profit earlier versus waiting for it to actually enter the red zone. Really advanced or experienced traders like to run these broken wing butterflies for a credit, meaning if you were to make this wing so broken, you can actually get a credit for it. And this is great if you really know what you're doing, as your transfer profit is going to be really high, because as you guys can see this, at expiration, there's no way to lose money on this trade unless the SPX is past a certain strike price. Versus if we were to come here, you guys can see it has to be within this region at expiration to be profitable. However, if you're not planning to hold until expiration, you actually have a much wider profit zone. So I like to think of this as a net. You're casting a net around where you think price will likely fall. And if you are wrong, you don't want to be punished too much for it, and you're not so concerned with price action to the upside. As long as you go far out of the money, you won't really have to be too concerned with this side right here. In this case, let's just say you think this is too close to the money and you have reasons to think that the SPX is going to go to 5,400. As crazy as that might be, let's actually extend this out and you can create a different butterfly here. And let's probably open one like this. And now you can see your break even, or the strike price in which you really need to be worried about, becomes 54.25. We'll say I'm just rounding that number. You have plenty room to the upside now, and at the same time the journey to get there is not painful, because let's just say the SPX ends up getting stuck around 380. You guys can see what happens here around 380. This is a very profitable trade relative to how much you are risking to the downside, and you might have some sort of security or faith that 5,400 might act as resistance. So if that strike ends up acting as resistance and price is hovering around here, you can end up having a huge return relative to how much you actually paid for the trade. So this is an example of the thought process behind what you can be thinking if you're speculating into the future, and that's kind of what this trade would have looked like at the start of the week. At the start of the week, the speculation for myself was the SPY will land somewhere around 530. And in my opinion, there's no need to be perfect or exact. 530 is a key psychological level that ends up translating to around 5311 or so. So even if you didn't do the conversion, you can even use 5300 and then just push it up a little bit higher. That's my tip, or something that I like to do. If I think we're going to land around a key strike on the SPX, I'll generally sometimes like to go 25 points higher just to give myself a little bit of room. This trade would have still been profitable even if you used the 5300 strikes. However, it would have been a little bit more nerve-wracking, because as the SPX hit 5,300 yesterday, right in this area here during power hour or the afternoon session, you're more than likely going to want to close the trade because of that fear of, if price was to gap up and keep going, there is the risk that eventually the trade will start going negative on you if you hold too long. So in this case here, by going a little bit higher than where you think price might go, that makes it a little bit more comfortable to hold, and it also buys you more room to the upside, and therefore most times you don't have to be concerned with the loss here. This max loss is a good gauge for how much the margin is going to be. So to open the trade, yes, it is a debit, and yes, it only costs $1.90 in this case here. I generally like to keep these trades around $1.50 to $2.50. So anything within that range, whenever I'm making these types of broken wing butterflies, I would try to fish for prices within this region as I can scale up into multiple of these. So if I'm paying $2 for the trade and I get 3, I know it's only costing me $600. Yes, the margin will be pretty expensive, but the margin will probably be $6K for a trade. For a trader such as myself that usually runs credit spreads, using $6K in margin is not really that hard or that difficult to do, because usually I might have $6K in risk and I'm only looking to make $600. So a trade like this that has for $600, you have the opportunity to make well over $6,000 is a blessing for most traders that trade credit spreads that are not aware of this. Again, yes, you have to have some sort of edge or you have to have some sort of gauge for direction, but again, you're not punished that much if you're wrong. So even if you take this trade a couple times and you end up losing a couple times, and let's just say you trade it with just one lot and you take a couple losses and you're not holding until expiration. So let's just say you take a $100 loss a couple times. So you get it for $2. You're taking a 50% loss on your debit paid, you're losing $200 in total. So you lose $100, you lose $100. That's if you run the trade twice. And all of a sudden you run the trade the third time, you end up getting right. And let's just say you end up with an 800-something% return, or even a 500-something% return is a great return on a trade like this. This percent return is based on your debits, not on your max loss, by the way. So not exactly on the margin you're being used. You can always just click this right here and say, see your percentage of max risk. And that will tell you, at this case here, it's actually a 74% return on how much capital is being used. But for the most part, you can also base it on your debit because, again, this is just a good gauge for your margin and not necessarily a max loss that you should actually ever be in. Coming around to the conclusion of this video, you might be thinking, well, why don't you just buy a call option? First of all, theta, that's always going to be terrifying. If you buy that call, theta is going to be eating away at your option. When you open a spread like this, at the inception, the theta is going to be negative, meaning your short theta, which you do still have time working against you. However, the theta is not going to be as bad. And the advantage of this is you're reducing the cost of the trade. This 52.95 call when this was open was going for $5.30. This whole trade cost $1.90. So you guys can see it's already less than half the cost of what it was to buy this one call option. As I mentioned earlier in the video, the way a butterfly is constructed is you're shorting 2 strikes and you're using that strike, or you're using the premium or the credit received from shorting these 2 strike prices to help finance the strikes you're purchasing. So we shorted 2 of these for $1.90. So that's almost $4 in credit being received. And then we're spending some of that on this. So this is $5.30. That's going to drop that cost down. And then this is purchased for 40 cents. Option Strat is doing all of the math, and your trading platform will do all the math. So you don't have to calculate this yourself. So that's what's bringing us down to this cost of $1.50. It makes it much cheaper than actually just buying the call. Yes, the call is now currently going for almost $30. So there is a huge return here that was made. But if we take a look when the trade was open here, so this would have been the Monday, as it was going for $5 and change. At one point, this trade dropped down to $3. This could have psychologically been difficult to hold, as that is a much larger percentual drop, as well as a much larger drawdown on your P&L. Let's just say you're in a couple of these, you're using about $1,000, and then the price drops down to about $3. You're now down over $400. You might not want to continue to hold the trade. So yes, in this case here, it worked out, but the whole point is, how do you reduce your risk? By opening up a trade like this, you are cutting down the cost of the trade. You're also eliminating your theta risk, and that is the major advantage, which means you can continue to hold a little bit longer to see if your speculation is going to play out correctly. The assessment that I use for the levels comes at the start of the week, as mentioned previously, on the gamma exposure. And being aware of high open interest levels, being aware of high gamma levels will inevitably lead to an edge in the markets. Once you understand high open interest levels, high gamma levels, the options levels are very significant. So if you're struggling to establish key levels and understanding where there might be potential support and resistance, I recommend you guys check out learning a little bit more about gamma exposure. It can help you identify key areas in the markets, especially after you've learned the foundations on support and resistance, trend lines. Things don't always work out perfectly like this one did here. In this case here, the SPY, this was the absolute gamma level for the weekly aggregate. And we can see that it ended up working out to the T as well as the highest positive gamma strike right here. But the gamma levels every week, I've been studying this for a couple years now, and in my opinion is one of the clearest ways to identify key levels for price action in the market. While this was a great trade and a great win for the week, this is not my only trade. I actually closed this trade out before I started doing this video, so this extra profit that's coming in is not something that I'm actually benefiting from. This is not the only trade in which I had. A personal trade or a big loss that I actually had was this right here. I actually held this through the CPI report and it did not work out pretty well. I had a decent size in this here, as if we just show you guys for an example. So I did take a really large loss earlier in the day here today. I realized this. So then I just decided to hop on the mic for the morning because I wasn't planning on taking another trade here for today. And it allowed me to have the time to actually showcase this for you guys here. So I was able to cut down on some of my losses on this trade here. However, I only had one of these. So I only wanted to put $1.90 in risk, 190 bucks in risk on this trade. In hindsight, obviously, I would have wished I had maybe my usual size of around 3 of these, as that meant I would have had a green week and then I could have continued to hold these into tomorrow for maybe a lotto. But this trade was too risky. I should have never held it through the CPI, but I was comfortable with the risk. I was looking for a really large win for if the SPX ended up staying within a certain range. It didn't work out this time, but this video is not necessarily about this trade, as well as most of my videos are not about my specific trades. I'm just trying to bring awareness to different strategies, different thought processes behind what one trader might be thinking when price action is doing one thing, different ways to reduce your risk even if you are speculating, and how to maximize your risk reward. If you enjoyed this video, let me know in the comments down below. If you'd like to see more on broken wing butterflies, let me know. Like the video if you learned something, share it, and I'll catch you guys in the next one.